there, my name is Robert Reynolds, and in today's video I'm going to show you an easy way to analyze the cash flow statement. A lot of people find this confusing, however it's not really that difficult once you know what you're looking for. So if you're looking for ways to improve your investing decisions, stick around and let me help you out. The cash flow statement. This is a pretty busy example. We're going to go through everything. It's not very difficult, but the cash flow statement gives us a massive insight into essentially how the business is being run. There's a big difference between the company's profits and the cash of the business. And the reason being is when we look at, for example, net income includes non-cash expenses. So we might make $100 in net income. However, despite some of those possibly being real expenses, like stock-based compensation, the cash flow statement might show that cash to the business is $125. So cash profits are very different, and we can better understand that from the cash flow statement. This example was downloaded from Ticker Terminal. Ticker Terminal is the resource that we use. I spend most of my day on Ticker Terminal analyzing business. It's broken down in this format, and it's got just about every single company that you could possibly want to analyze. We do have a link in the description. We'd really appreciate if you used our link if you were considering using their services. Okay, let's get into it. Now let's start off, actually at the very bottom here, you often hear free cash flow. What is free cash flow? Free cash flow is a very simple metric. It's cash from operations minus capital expenditure. So check this out. Here's cash from operations minus your capital expenditure, and you get $195.99 million. That's your free cash flow. Very simple metric. Free cash flow, cash from operations, minus capital expenditure. So let's go to the top of the page here. Let's break down that cash from operations. You can see at the start, it starts off with bringing over your net income, and then we're adding back depreciation and amortization. So let's talk about depreciation and amortization, and then we'll talk about stock-based compensation. Depreciation and amortization can be two different, it can be sort of erroneous or it could be beneficial, and you got to be very careful with that. In the example when we were analyzing the income statement, we mentioned this example where we have a van that looks something like this. Maybe it's a UPS van, I'm not sure. But this van essentially delivers packages and it's going to last 10 years. Now, after 10 years, it's going to break down. It's going to end up in a scrapyard. What do I do then? Well, I got to replace that van. So this costs $10,000, and in 10 years, excuse my bad writing, and in 10 years, we're going to have to pay another $10,000 to replace that van. How much incremental growth will that bring to the business? Zero. It'll bring no growth whatsoever. So that's what's known as maintenance capital expenditure. The other type of capital expenditure is, I own one coffee store, I'm Starbucks, and if I generate $100 here, I may generate another $100 if I open another store. And so that capital expenditure will lead to higher profitability, higher top line revenue, etc. That's growth capital expenditure. Differentiating both of those is very important. But the main takeaway is depreciation and amortization are non-cash expenses. I buy a van for $10,000 and in 10 years I need to replace it. So this becomes an expense to me because eventually it's going to be worth nothing. So every year I write down $1,000. It's a real expense if it's maintenance capital expenditure. It's not necessarily a real expense if it's going to lead to growth into the future. It's going to have a fantastic return on that invested capital. So that's something to look out for. Depreciation is essentially writing off real assets. Maybe a property, maybe a vehicle, something like that. Amortization is writing off an intangible asset. Let's say I'm a biotech company and I just got awarded a patent for some sort of oncology product. I've got 20 years for that to amortize, and I can write the value of that intellectual property off as amortization. So at the end of that, what ends up happening? Well, my protection goes to zero, the intellectual property goes to zero, the barriers to entry come down, anyone can compete with me using the exact same formula to create whatever the drug that is. So depreciation is essentially writing down a real asset, amortization is writing down an intangible asset. They can be real expenses in the case of maintenance capital expenditure depending on the business, or it can be sort of related to growth. And if it's related to growth, it'll have a positive return on that invested capital. So we add that back, and that's the main takeaway is we've got our net income and we add back depreciation and amortization. Next, let's talk about stock-based compensation. There are different sort of shareholder values essentially worldwide. In Germany, for example, they use a stakeholder model where they're more loyal to stakeholders as opposed to shareholders. They would be more interested in serving employees, not saying which one is correct or incorrect. It's just a different corporate governance model. In Germany, it's more stakeholder driven. In the United States, it's more shareholder driven. And under that shareholder driven sort of corporate governance, stock-based compensation aligns inside management with shareholders. So stock-based compensation in itself is not necessarily bad, because if you're getting paid in stock, you're incentivized to make sure that that stock pushes higher, because that's essentially what your payment is. Now, in the past couple of years, stock-based compensation has been abused. I'll give you an example. You've got a company like Snapchat who just reported, and they approved a $500 million buyback in Q4, but they couldn't give any guidance on their business. It continues to decline in terms of ad revenue. Now, when you look at their stock-based compensation, it's $1.1 billion on a $13 billion market cap. It's pretty erroneous. It's about 7-8% of the entire market cap in stock-based compensation. And the share buyback is propping up the share price, possibly to let investors sell out. In that circumstance, it's a classic example of how stock-based compensation is being absolutely abused. Historically, though, a lot of companies have a little bit of stock-based compensation plus a salary, and it aligns shareholders with insiders, management. So you got to be very careful there, because this is a silent killer. Essentially what's happening is the number of outstanding shares are increasing, your ownership in the business is decreasing, and in the case with Snapchat, trailing 12 months, 1.1 billion in stock-based compensation on a market cap of 13 billion. They're not profitable, and they're using that non-cash expense to buy back stock. Very erroneous. You got to be very careful. It's not always bad, but it's definitely something you need to pay attention to. It aligns shareholders and insiders with the same sort of objectives, but it can also become a corporate raid where insiders are essentially, I would say it's almost like corporate theft. So capital expenditure, very important. Depreciation and amortization, is it maintenance or is it growth CapEx? And in stock-based compensation, is it egregious or is it not egregious? Both of those are very important because they're real expenses. They can add to growth or they can be real expenses, so you got to be very careful there. Sometimes you might see a company talk about its free cash flow when its net income's negative, and its net income is essentially negative because they're writing down maybe maintenance, CapEx, or massive stock-based compensation. So essentially all that's happening is, again, in the case of Snapchat, you're essentially losing 7-8% because that's the dilution in the market cap every single year to stock-based compensation plus the losses on top of the business. Got to be very careful there. Here you'll see a segment at the bottom of the operating cash flow. Now below here you can see, and not many people consider this, it's always ignored, working capital. Working capital is very important. Over at Ticker Terminal, they always include the memo for the change in working capital. What is working capital? It's current assets minus current liabilities. That's your working capital. In some circumstances, what you might end up saying is the company might erode its working capital. You got to be very careful. If you've got a pattern of consistent negative working capital, ideally you would want to see this working capital continues to be quite stable. It's a lot better than seeing it fall off a cliff. So always check on net working capital, changes in net working capital. Again, very simple. It's the current assets minus the current liabilities, and that'll give you an idea of what the working capital is. Always pay attention to that when you're looking at cash flows. Okay, that's the top half of it. Some of the stuff you need to pay attention to, non-cash expenses, and as well as that changes in working capital. The next segments, you've got cash from investing and cash from financing. This is all about capital allocation. Capital allocation mix can be different for different types of businesses. There's nothing wrong with that whatsoever. The one way in which we can determine the success of the business is by looking at the return on invested capital, which we do have an example and tutorial on the channel. I'll leave a link just above if you want to go check that out. That'll give you an idea of management's quality in terms of the return on their invested capital in the past. What type of capital allocation are we talking about? Well, Let's say there's an opportunity for a company to go and buy a business, one of their competitors, do a little bit of mergers and acquisitions. They're going to buy that business, and including the synergies, you're going to pay 15 times earnings. At the same time, your own stock, which is a competitor growing at the same pace in the same industry, is priced at 10 times earnings. What do you think is the better investment? Buy back your own stock or buy a much more expensive business? In that circumstance, buying back your own stock would make an awful lot more sense, and that would actually show up in the return on invested capital. So these are the decisions that are made from a capital allocation perspective. As you can see here, under cash from financing, you've got issued stock. So how are they financing their business, or how are they paying back shareholders? If they're financing their business, they're issuing stock. If they're paying back shareholders, they're repurchasing that stock. Repurchase of common stock is share buybacks is more tax efficient. Let me explain why. Let's say there's $100. I'm the only investor in this business, and there's a 20% corporate tax rate. That would mean that the money left over within the business of that $100 in income is $80. Excuse the really bad handwriting here. There's $80 left over. Now, what the company can do is they could take that $80 and they could buy back their own stock, right? Now, there is a new law that just came in where there's a 1% fee on that, or 1% tax. But they can use that, $80 in order to buy back $80 worth of stock. Just for simplistic, we'll use that. So you can buy back $80 worth of stock, or you can take the $80 and you can pay it out in dividends. And a lot of people look at that and say, great, I get $80 in dividends. Only, this is taxed. As an investor, I get taxed on income tax. And if you're on the higher rate of tax, it's closer to 50% of your salary, so you end up with $40. It means that you've lost $60 of the net income value of the business. So in that circumstance, it's better to buy back some stock, so as I don't get tax penalized, or double jeopardy as I call it. And that makes a hell of a lot more sense for me because I get more ownership in the business over time. It is really effective with high quality capital allocators when they buy it at the right price. Some businesses just buy back stock at any price, and that's something that you need to look for, but it should show up in the return on invested capital. So capital allocation will show up here between capital expenditures, cash acquisitions, investment in marketable securities. That could be, like, for argument's sake, you look at Walgreens. They've also got an equity position in AmerisourceBergen, another publicly listed company, and that would show up when you're invested in marketable securities. Cash acquisitions, that can be cash or debt. If it's paid with debt, you'll show up here. You'll see debt issued. Pay back debt. Again, when we're looking at capital allocation, would it be better to buy back stock or pay down debt? And you have to consider the interest rate on that debt. What would be the better return? If the interest on that debt's 8%, would I get a higher return from buying back my stock or paying down that debt? These are considerations that have to be made. And we can see all of these decisions in cash from financing and cash from investing. It's very, very, very simple. But essentially what these two segments tell us is these are the capital allocation segments. What are management doing with the business? And then when we consider the return on invested capital, we can see whether they're really good at allocating that capital or not. Finally, at the end here, you'll see there's a couple of supplementary data points that Ticker Terminal will show you. One of them is free cash flow, and then it has free cash flow margins. A free cash flow margin is the free cash flow divided by its revenue. Free cash flow conversion would be free cash flow divided by its net income. Two distinctions that will probably come up. Don't get confused. You want to understand what the conversion is. You want a high conversion, 60-80% between net income over the free cash flow, and then the margin itself is not as important. But what we want to see is, or what's more important to us, is the conversion between net income versus free cash flow. That's very important. We want net income, free cash flow to be somewhat similar. If you're interested, we also cover the balance sheet and the income statement here on the channel. Thank you very much for your support and have a great day.